Hey guys, welcome back to the Value Investor Show. Today we will be covering Meta, and welcome back to the new series I launched last week. Are the Max 7 stocks undervalued or overvalued? So far we've gone through Google, and today I want to talk about Meta's stock performance, the fundamentals, the latest news, the intrinsic value, and finally my personal thoughts. Over the last 2-3 weeks, we have seen a return to fear in the market, yet the S&P 500 keeps floating around its all-time highs. As I said in my last video, this is primarily because of the Mag 7, which now make up 34% of the S&P 500, meaning that the market is largely being driven by just these 7 stocks, and most notably Nvidia. Today though, we are focusing on Meta, a stock that has been beaten down this year. Over the last 5 years, its relative performance has been strong and as strong as others. Year to date, however, the company is just up 9%, while the past month alone the company is down almost 11%, making it the worst performer amongst the Mag 7. In contrast, over the last 5 years, the return has been 123% compared to Google's 227%. Now, with Meta being down almost 12% over the last month, I personally bought heavily into Meta in 2022, and my position is now up 4 times since that investment. Yes, I'm bullish on Meta and I trust this company with my life. It's a cash machine, but it's not all rainbows and sunshine. There are a few things going wrong, and today I want to unravel everything so you know exactly what those are. As I said, I invested in Meta back in 2022 at an average cost basis of $160, and today I'm up 300%. Now, as I said in my other videos, I would review my full portfolio at 10,000 subscribers. So if you're new here, I do spend a lot of time to put these videos together for you guys for free. So if you can hit that button, it would mean a lot. Now, there is one person in particular that has been very vocal recently, and that is Michael Burry, who many of you already know. He has been very bearish on the market, calling out potential bubbles and claiming that some companies are overstating profits. Recently, he posted something interesting on X, and keep in mind that this guy hasn't posted on X for 3 to 4 years, and now all of a sudden is very active. He said, understanding depreciation by extending useful life of assets artificially boosts earnings, one of the most common frauds of the modern era. Massively ramping capex through purchase of Nvidia chip servers on 2 to 3 year product cycles should not result in the extension of useful lives of compute equipment. Yet this is exactly what all the hyperscalers have done. By my estimates, they have understated depreciation by 176 billion between 2026 and 2027. By 2028, Oracle will overstate earnings by 27%, Meta by 21%, etc. So basically what Michael Burry is saying is that companies like Meta, Oracle, Google, and others are extending the useful depreciation of their chips, of their AI infrastructure by quite a lot. But it's not just the first one to point this out. Jim Chanos said something similar almost 3 months ago. He raised concerns about Meta platforms specifically and other hyperscalers that may be overstating profits by using extended depreciation schedules on their AI infrastructure. Essentially, Jim Chanos is saying that if the true economic life on the GPUs is actually 2 to 3 years, most of its profits are materially overstated. Noting that Meta's depreciation capital base stood at 210 billion as of June 30th, with a reported useful life of 11 to 12 years. Essentially, both Burry and Chanos argue that companies like Meta, Oracle, and others have been investing heavily in AI infrastructure, and these assets in reality often have a 2 to 3 year product and economic cycle due to the rapid hardware obsolescence. Yet the companies are reporting much longer useful lives for accounting purposes, for Meta recently up to 12 years. By extending the useful life, the annual depreciation expense recorded on the income statements drops sharply. Because, for example, if you think about a $10 billion server investment over 2 years, that means a $5 billion depreciation expense per year. But over 10 years, that means only 1 billion per year. So lower depreciation artificially inflates operating income and net income as a major expense is understated while revenue continues to be fully recognized. But the problem continues because continued aggressive capex means that the problem will amplify with each new wave of AI investment. Now, putting accounting aside, let's look at the business itself because Meta is still a cash machine. It has been growing revenue at 22% CAGR over the last 8 years, which is enormous. Though margins haven't been consistent, still the company's growth is strong. Margins are high and free cash flow continues to track share price just as it did in 2022 when there was a massive opportunity to buy. Among the Magnificent Seven, Meta is the only company trading below its 10-year average EV to EBITDA average multiple, which shows that it's underperforming its peer on a valuation basis. If we look at Morningstar's estimates, they show revenue growth of around 10% over the next 4 to 5 years, with adjusted net income and operating margins of around 30 to 37%, alongside buybacks as well as dividends being distributed for the company. Morningstar expects Meta to have a hit on free cash flow to the firm for 2025, and then from 2026 onwards, it will show some improvement, while operating income will also continue to improve and hitting 130 billion by 2029. Now let's talk about valuation. If we take the intrinsic value of Meta today based on 2026 projections, it comes to around $432 a share, which is below the current 631. But now let's look at the three valuation scenarios, the base, bull, and bear case scenarios, assuming growth over the next 5 years. In my bear case, I assume 10% revenue growth. However, I assume a 6% net income and free cash flow growth, saying that they're basically lagging their revenue growth, as I do believe that revenue will continue to increase at double digits, and a P ratio of 15. On my base case, I assume 10% revenue growth and a net income and free cash flow that matches that, as well as a P ratio of 20. And in my bull case, I'm assuming 12% revenue growth and 15% net income and free cash flow growth. So in my bull case, I'm assuming that Meta is actually expanding its margins and ability to convert net income into free cash flow, with a P ratio of 25. In terms of metrics, the company is a beast. Gross margins are very healthy. Revenue, net income, EPS growth has been insanely good. The return of investment, equity, and free cash flow has been outstanding, and the company is relatively very good on debt. They have increased their long-term debt over the last few years due to their increased investment in AI. But apart from that, the company is a great company with an A+ rating. Now, under the bull case scenario, using the DCF method, the intrinsic value comes at $670, and by the EPS method is coming at $1,100, giving me a margin of safety of 4% and 42%, which is both below my 50% margin of safety target under the assumptions that I have already talked about. If we look at the base case, which the base case is based on the Morningstar assumptions, the intrinsic value with the DCF method comes at $543, while with the EPS method at $880, which gives me a margin of safety of minus 18% and 27%. Again, not undervalued under the DCF method, and using the EPS method, the undervaluation is not enough. And finally, under the bear case, the intrinsic value with the DCF is 456, and with the EPS method is 731, which gives a margin of safety of 12% with just the EPS method, while the DCF method suggests that the company is overvalued. So again, not enough for my target of safety of 50%. So closing on my thoughts on Meta, I am not buying Meta right now. While I believe in the company, I believe in Mark Zuckerberg, and I plan to hold it for the future and not sell anytime soon. I think the current risk reward is just not ideal. I think the company has a lot to prove in terms of the investments that they're making, and I do believe that there are better opportunities out there right now. But I do think that Meta is a 3 trillion market cap company in the making, but the timing and path to that valuation remains uncertain. Thank you so much, and I'll see you in the next one.